Welcome back. Now, strong foreign inflows, improved fiscal discipline and confidence in the inflation outlook have made local bonds one of the standout performers in emerging markets. James Turp, fixed income head and portfolio manager at Sanlam Investments, joins us now to unpack what's driving the rally and what risks investors should still watch. James, thank you so much for your time today. So we ended off 2025 pretty strong, started 2026 with even more momentum. Is the strength we are seeing in the bonds market going to be sustained, or are we nearing the peak of that rally?
Thanks very much for having me in Taolong. That's the golden question. We came into 2025 off the back of that election-related bond rally of around 17%. And I honestly didn't think it was going to be that good a year. We did just around 25%, just over it in the Sim bond fund. And now the question is back in our faces, how are bonds going to do this year? Now, last year, everything went right for South Africa and bonds. We've got currency strength coming into 2026. We've got lower inflation forecast. We're thinking inflation can be anywhere around 3.1% this year. If that
very
plays
close to the Saab's target.
That's right, so the Saab's got it in their forecast, which they'll adjust on Thursday, but they've got inflation trajectory actually moving lower. We've got it going a little bit higher in 2027 as the economy starts to pick up and growth normally leads to inflation. But if inflation's got that 3 handle that we know the governor spoke about last week for this year, there's no reason why bonds shouldn't remain positive. We could have outlook changes for credit ratings. We know we got the Standard & Poor's upgrade last year with a positive outlook. It's possible that we see Moody's and Fitch also change to a positive outlook, maybe not hiking up or increasing the rating just yet, but the outlook is positive. We should have improved growth outlook. So with that and a good budget, bonds should have a reasonable year. Probably not as good as last year. Last year was outstanding. But the big thing for us, I guess, is going to be the budget. We've been looking at metal prices, particularly the platinum group at the end of last year really shot the lights out. That all comes through over the next year into corporate income tax. We're expecting good tax levels at the budget. We know that most people are expecting that. You spoke about fiscal discipline. All of those matters pulling together could lead to stable and stronger bonds here in South Africa.
And that was going to be my next question around the optimism and the rally we are seeing in precious metals and the rally we are seeing when it comes to the rand, which has hit levels last seen in 2022. So that, of course, going to filter through eventually when we do see what position we're in when it comes to our fiscus in the budget next month. Let's talk about the biggest risks to this rally we are seeing in bond markets. James, you talked about inflation, and that could potentially tick higher in your forecast. But talk to me about the kind of risk the local government elections then present.
You hit the nail on the head there in Taolong, because I was going to say geopolitics, geoeconomics and local politics are going to be the biggest risks for us this year. So local government elections, that's going to stir things up. We've seen an interesting by-election results coming through already, where you've got certain changes already happening. So that normally leads to some political noise, and so that's going to be interesting. Will the DA, for example, take Johannesburg? Will there be these big swings that were expected, and how do the opposition parties respond? Will it remain coalition politics? Lots to see on the domestic side, but I think the global geopolitical arena is going to be even more volatile. We saw that already, haven't we, with tariffs being this big story of last year. Then markets have a great year. This year starts off with more strange developments coming globally on the political side. So we just don't know where this ends. You've seen what's been going on in Europe. You see the headlines around Greenland.
Or Iceland.
Iceland, rather. Yeah. The big chunk, right? And so you've also seen countries like Canada, who historically have been have a huge dependence on the USA, breaking ranks. You've seen the UK comments there, changing the dynamic. So this uncertain world that it's almost some commentators saying we're returning to a pre-World War II world, pre-NATO, where NATO was put together after the war to bring these countries together, all abide by these rules and laws, and now it seems to be a strange, almost free-for-all, where the strongest country makes the rules. And that's what's playing out in the currency markets, where there's talk of what they're calling a debasement trade. And debasement was the term for when they used to take gold coins and shave bits off to make the actual intrinsic value less. They're calling that because there's less faith in fiat currencies, in the currencies that we carry in our pockets, and central banks and global investors losing faith in that and preferring commodities that have a real intrinsic value, and central bank behavior changing their reserve structure to include more commodities. Has seen gold through $5,000 this week, and some analysts think it can keep going at the same pace. So that's really good news in some ways for us in South Africa, because we respond to those commodity prices, particularly platinum, but legacy response to gold. So that's what's also been a good tailwind for us here in South Africa. You've had the weaker dollar, you've had stronger commodities, and you've had this fiscal about turn with lower inflation expectations and fiscal discipline, all conspiring positively at the moment.
And just quickly before I let you go, central bank meetings this week, the Fed meets, the Saab also meets. Let's talk about the Saab. Are bond markets pricing in a cut or a hold?
They're pricing in a coin in the air at the moment entirely. So it's a difficult one. The evidence on inflation probably enables them to cut. They're probably going to mark their inflation forecast lower. They probably, though, flag geopolitical concerns and their view on what they call a pro-cyclical cut, which means the economy's picking up and you're cutting rates to fuel it. They might be a little cautious on that. So the market's not entirely sure. I'm switching from 1 minute to the next. When the currency strengthened this morning, it made me feel they've probably got enough there to cut rates, since their forecast's around 17. So I'm not too sure. The market's pricing 50-50 chance of a cut at this point. The Fed's not expected to cut on Wednesday, and so you probably find they might just hold. I'm not too sure at this point. For bond markets, if they hold off the cut until March, it flattens the curve. It secures lower inflation, or it contains inflation. So they can afford to be a little patient on this should they want to be. And so maybe they just hold off. It's a very difficult one to call.
James, let's leave it there. Thank you so much for joining us and sharing your insights with us today. That was James Turp, Fixed Income Head and Portfolio Manager at Sanlam Investments.